Hi everybody, Lance from ThetaTraders.com here. This video I'm going to be deep diving what Delta is, how to use Delta in terms of making option selling techniques, and then some of the parameters that I use when I look at Delta to make option recommendations. Let's get right to it. The definition of Delta as the option Greek is it measures the rate of change of an option's price based on a $1 move in the underlying asset. So if you think about it with just stocks, if you own a stock and it moves a dollar up, obviously you would make a dollar per share profit, and your delta would be one in that case. So just owning stock, your delta is one. But when you're buying an option, you're getting a certain amount of your delta based on where the price is compared to the actual price of the stock, implied volatility, expected move, all these other factors that I'll do future videos on. For call options, we do a positive delta. This ranges from 0 to +1. If you're pretty much at, say, 5 minutes before market close and you have a stock at $200 a share, you bought a call at $120 a share, then the delta will pretty much be one in that case, because if it happens to move up another dollar in the next 15 minutes, your premium will be up a dollar. Delta could be 0, right at expiration, say a few minutes before, stock's at 200, and you have a bought call at, say, 220. It's not going to go up 20 points in a few minutes, so then the delta will be 0 in that case. Put options, they go from 0 to -1. So notice that the put options are negative values and the call options are positive values. So if you have a delta of 0.3, so you buy an option, call options 0.3, that option will gain or lose $30 for every $1 move in the stock. So if it goes up a dollar, you would gain 0.3 in the premium. If it goes down a dollar, you would lose 0.3. That's not factoring in gamma, and mostly gamma in that case, but just assuming on the delta, we will go up 0.3 if the delta is 0.3. So delta also is the approximate, doesn't mean exact, but approximate probability that an option will expire in the money, or ITM. So let's say you have a put with a delta of -0.2, and let's say you sell that put option. In that case, it would be about a 20% chance of it being in the money at expiration. So let's say a stock's at $200 a share, you sell 190 put, and the delta is -0.2. There'll be about a 20% chance that at expiration, it will be below that strike price. So you could sell options with a low delta to increase your odds of success. If you're selling with a low delta, there's a less chance that it'll go in the money at expiration, and then you would get out at a profit if you're selling those options. Now, delta is not static. We will do future videos on all these. It's based on the underlying price movement. If you bought say a 0.3 delta call and then it moves up, the delta will go up higher as it keeps going up. Times expiration, that has to do with your theta decay. If you have more time for a position to move in your favor, then the delta could easily be factored into that. And also implied volatility. Implied volatility is how much variation in a possible stock price it might be. For example, let's say you sell a put of a -0.2 delta and the stock goes up, then it's even further out of the money. It's a bigger difference from where you sold your put and the actual price. The delta might go to -0.1 or even less. This would be good for you because not only is it further away from the current price, there's also less time for it to get to that price. Now, if a stock drops, your delta could go up. Maybe it goes up from -0.2 to -0.4. In that case, it's a little bit more risk because there's a greater probability that it could go in the money at the expiration. This shows a graph of your delta and the stock. At the money, that's the exact same price. Say the stock's at 200 and you have a 200 put. Exact at the money is a 0.5 delta. Notice that this curve is not linear. It is different slopes as we get to a higher delta. So to keep it simple on a buy side, stock's at 200, you bought 100 call. If it goes from 200 to 201, your delta will not change that much. It's already pretty much at 1 in that case. But let's say the stock's at 200 and you bought a 200 call. If it goes up a dollar, you're going to have a much higher delta. The slope of this line will be greater, nearly at the money, because the premium will be worth more with another dollar move up. At expiration, if you had a 200 call and it closed at 201, that premium will be worth 1. And it also works on the negative side. The further out of the money you are, notice how the slope is more narrow. All right, so out of the money options with a low delta lose value quickly as the expiration nears. Because it's so far out of the money, there's a less chance that it's actually going to get to the in the money. If you combine this with theta to take advantage of time decay. Now, ideal setups that I typically look for at thetatraders.com is I go short 0.1 to 0.3 delta. If it's a put, it'll be negative 0.1 to negative 0.3. If it's a sold call, like a covered call, it'll be plus 0.1 to plus 0.3. These are far enough from the current price to typically stay out of the money. It's also close enough to expiration to let theta do its job, and then I'll look for relatively decent amounts of time before that value expires worthless. So popular strategies with just the delta. For credit spreads, you could sell the short option between 0.1 to 0.3 delta. Sometimes I'll typically go a little lower than 0.3. Sometimes I might even go a little less than 0.1. For 0 DTE, I typically look around 0.07, 0.08 delta. And then you want to buy the long option further out of the money to cap your risk. This makes it a defined risk trade. So let's say a stock's at 200. I might sell a put at around 190 or so. That might be about a 0.15 delta. But then I'm going to buy one even further from 190. I might buy a 185 put to make it a credit spread. Cash secured puts, lowest delta again around 0.15 to 0.3. And this is to either collect premium or to buy a stock at a discount. So let's say I really like the stock that's at 200, but I think it's a little overpriced. Maybe I sell the put at 190, and I'm perfectly fine getting a sign at that 190 to hold it for a long term. Or you could do the wheel strategy, sell covered calls. And I'll typically sell covered calls at a similar delta at the positive 0.15 to 0.3. Iron condors, you could sell the put and call credit spread together. What's good about this is one side is guaranteed to work at expiration. And you can profit from range-bound movement. If you're not seeing a lot of up and down moves on a stock, an iron condor could be preferred there. So advantages of selling your lower delta options. You could have very high win rates, 70 and 90%. There's pretty fast time decay because you're far out of the money. It's flexibility in strike selection. You could have some variability in where you sell your puts. And automate or systemize with different indicators that I show at thetatraders.com. Some risks to watch out for. Delta can grow fast if a trade moves against you. Remember the slope of that line near at the money is a pretty high slope. So if you're at, say, a 0.45 delta on a sold put, you could easily get in the money in that case. Volatility spikes will change your option premium. I'll do a future video on volatility with Vega risk. And you need good risk management, knowing how to do stop losses, rolling them, hedging with other positions, etc. So personally, I focus with spreads, define risk spreads, because if it goes way against you and you don't have time on like a gap down movement, you do have a defined loss. If a 5 whiff credit spread, which is what I typically do, you only need about $500 minus the credit you take in. So typically about $450 or so. And that's the max you could lose. If you just sell a put, like a cash secured put, you could theoretically lose the strike price times 100 because it's undefined risk. using technical and volatility signals to time when to enter. And my target goal is 2 to 4% a month, and that includes stopping out on some of your trades. Not every single trade will work, but that's perfectly fine as long as most of them are working at your target profit, and then you're defining your losses. So here's an example that I'm considering for my members. For PDT, Timu, right now it's been on a pretty bullish move. It started to drop down below the EMAs, and now it's starting to consolidate. We might be above the 9 EMA shortly. We're making this video on August 5th. Members saw access to this a little bit earlier than general YouTubers. So if you're interested in that, you could join thetatraders.com, and I typically do videos for members before YouTube. Anyway, for this one, you can see it's starting to consolidate. It was range bound around the 105 price or so for quite a bit. And this is the option chain that I'm considering. 45 days out, you could go down to the 95 put, which is lower than that consolidation around 100 to 105. And we'll be buying some protection at the 90 put, making it a credit spread. The delta was 0.11 on the 95 put. And right now you could get some premium between $38 and $46. So you would only need 500 minus that. Let's say you get about $40. You would only need about $460 to put on a credit spread to possibly make about $40. And that's a good return, almost 9% or so. So in summary, you want to understand delta as probabilities. Although the technical definition is a dollar move up, they'll show how much the premium is worth. I typically use it more as a probability based. Use your deltas to increase your odds of success. Psychologically, that helps you because you're going to get more wins. Pair your delta with the theta for passive income. So think about different theta strategies, and I'll do future videos on theta. And then monitor and adjust when your delta is changing. Again, if you're interested in daily alerts like this, I do longer dated credit spreads every day, and I do a 0 DTE on SPX. You can join the quarterly or lifetime plan at thetatraders.com. Thanks for watching this video. If you have any questions or comments, leave them down below. I'll read and respond to each one, and I'll see you guys on the next one.